say if someone's done a 40% per annum for say 5-7 years, has that come from like just a couple of stocks out of a 10-20 stock portfolio?
If you were to play 1,000 hands and you have 80% favorite, to win the hand, 8 out of 10 times you're going to win the hand. But it's possible that, you played 10 hands and you ended up losing 5
All
of
10.
them.
Or even all 10.
Or
right, in that
even
case,
all 10,
yeah.
But let's say if you were to do it over 1,000 hands, the number is going to get closer to the 80%. So that's what we try and focus on. One outcome doesn't really change what we're doing, but we try to, ensure that we stick to the processes, rather than change every time when the outcome doesn't work out in our favor.
Correct. That makes total sense. You don't want to be a one-hit wonder. Rather, the process should be such that no matter like the heads and tails, over time the odds will play out and the strategy's edge comes out, right?
Yeah,
in
absolutely.
the returns. So let's get down to that process then. Yeah. So we have 4,500 stocks listed today, right? So there are a lot of options. How does one get down to the actual research ideas before they start researching and get to the investments?
Sure.
How do they narrow down that universe?
So out of the 4,500 businesses that you mentioned, right, I think the investable universe is probably like 400-500 kind of companies.
Correct.
There aren't more businesses that are actually
Investable.
investable, or have a good business that you would want to look at.
Right.
And then from that you want to narrow down to a list of about 100 businesses. After looking at these ratios, then you want to take a deep dive into each of these businesses. So that's the entire process of getting down from that 4,500 to
Right.
the smaller universe.
There are times when a business could be great, but not necessarily a good investment. But I would also say there could be times where it's a good investment, but might not be a good business. I'll give an example of the latter first. We were once looking at a company, they were in, in the space of manufacturing some films. They had a, land which was valued at close to 2,000 crores, but the market cap was close to 400 crores. Now, the business is not something that, made us interested in that stock, but they had that land that was lying there. At some point in time in the future, the value of that was going to be realized. So you're not getting into that business for, you're not investing in the business for what the business could make out, but it's plainly because they have a land that's worth 5x.
So welcome to the QodeCast, where we demystify the process of systematic investing. I am Pratik Tandel. I am an analyst at Qode, and today with me I have our fund managers Gaurav Didwania and Rishabh Nahar. Today we are going to basically address the question of how do you invest in stock markets. So thank you guys for being here, and I'm excited for the conversation.
Thanks Pratik. I mean, we are excited for this too.
Absolutely.
Yeah, so let me start with the first question, right? Every successful investor talks about luck being an important part of their success, right? So how much of that is, how much does luck play a role in Qode's success, and how much of it is a repeatable process?
I think I'll take that one. So I think, Pratik, I mean, luck is always going to play a part in investing and in life too. So that part is always going to remain. The idea that, what we want to do at Qode is we want to reduce that role of luck to, to whatever extent we can. And, investing is full of uncertainties, right? So, and you have to deal with that uncertainty. But the idea is that can we create processes to reduce that uncertainty and increase the chance of success? So when we are looking at investing, we are looking at as a game of probabilities. So you want to increase your chances of success by creating systems, creating processes, so that you could do, you could make better decisions.
Right.
So if I were to, judge a fund or a fund manager, if I were to invest in, what I would look at is that, is the process repeatable, right? Say if someone's done a 40% per annum for say 5-7 years, has that come from like just a couple of stocks out of a 10-20 stock portfolio? Or is it, a larger number? So is the process repeatable or not? If it's repeatable, then, I want to back that fund manager, I want to back that system and process.
Right.
So that's the entire idea.
Yeah, no, I think Rishabh put it well, but if I was to draw an analogy, I can talk about, let's say, the game of poker, where, what you are focusing on is making the right decisions given the information that you have. And it's possible that, you can make a right decision and, still end up losing. And, on the other hand, you can make a wrong decision and still end up winning. But that doesn't change what we do, So we try to focus on making the right decision, time after time. The outcomes don't matter to us as much, as long as we're trying to focus on doing the right thing.
You also speak about that, the 1,000 hands and like how
Yeah.
it has to play across.
Yeah.
And if you could just
Yes. So, for example, if you were to play 1,000 hands and you have 80% favorite, to win the hand, 8 out of 10 times you're going to win the hand. But it's possible that, you played 10 hands and you ended up losing five
All
of
10.
them.
Or even all 10,
Or,
right? In
or
that
even
case,
all 10,
yeah.
But let's say if you were to do it over 1,000 hands, the number is going to get closer to the 80%. So that's what we try and focus on. One outcome doesn't really change what we're doing, but we try to, ensure that we stick to the processes, rather than change every time when the outcome doesn't work out in our favor.
Correct. That makes total sense. You don't want to be a one-hit wonder. Rather, the process should be such that no matter like the heads and tails, over time the
Yeah.
odds will play out and the strategy's edge comes out, right?
Yeah,
in
absolutely.
the returns, right? So
Absolutely.
now, like before we get into the nuts and bolts that we want to discuss today and go into like questions of like how do you pick stocks and all of that, I just wanted to understand like what style of investing does Qode follow, right? So there are various styles. So what exactly does Qode what's the niche that they try to pick stocks in?
So I would say, see, eventually we end up doing a lot of things, but the principle I can describe that for you. I think it's very well put in, this book, by Peter Lynch called One Upon Wall Street. So he describes the company, breaks down the companies into 6 different types. The idea is each type, works well if you know enough about, the company, and if you know enough about what you are looking from that particular company, it works really well. It's possible that we could focus on one type more, than the other, but I can tell you broadly all 6 types, we try to look at it in our investing framework.
Right.
Yeah, I mean, I could just elaborate a little bit on that, right? I don't think we were giving it a label as such, like this is our style of investing. So a lot of people would do like, say, growth or, turnaround kind of situations. What we are essentially looking at is that, businesses that we understand and, we want to look at earnings growth. There needs to be visibility. So I think in the long term, what we've come to realize is that in the long term, if a company is growing at, say, like the earnings are growing at 15-20%, the stock price will pretty much match its earnings growth. Or even if you want to look at return on capital employed for that matter. So I think that's what we are broadly looking at.
Right. So there's no like fixed style that we follow. Is it growth investing or value investing? It's more on finding companies that get earnings, and that's
You could label
what
it,
you
but I
wanna-
mean, we don't want to give it a label in
Yeah.
any way, right? Like
Right.
the process is pretty simple.
Right.
Yeah.
So let's get down to that process then. So we have 4,500 stocks listed today, right? So there are a lot of options. How does one get down to the actual research ideas before they start researching and get to the investments?
Sure.
How do they narrow down that universe?
Yeah.
Sure. So, I can tell you when we're looking for companies, we're largely looking for 2 broad things. One is capital allocation. The second thing is scalability. Now, any company that we want to invest in, should have, for example, they should be making higher margins. They should have better working capital. They should not be waiting for the vendor to be making the payment. They need to be, not investing that much in the assets. They should be having a higher, asset turnover. That being said, that's the capital allocation of it. The second part is the scalability. If the company is not scalable, then there's no point looking at that company. I can in fact give you an example. There was this one company that we had looked at some time back. Bajaj Consumer was the name of the company. They had roughly 80% revenue from one product and more than 50% market share. Now the question is how much more can that product grow? If you look at the capital allocation side, the asset turnovers were really high. ROCs were in the range of 50 to 60%. But if you don't do anything with it, how are you going to go any place else? So we feel that both of them are equally important. We try to look at it hand in and don't try to prefer one over the other, but largely we try to look at these things in a company when we're looking at it.
Yeah, I mean, if you want, I could just elaborate a little bit in terms of the process, right?
Yeah.
So what Gaurav mentioned in terms of, say, capital allocation or in terms of, working capital ratios, we would like to give a number to something like that. So I would call it more like a scorecard kind of an approach, wherein something like a capital allocation could be measured in terms of return on capital employed. So if a company has a high return on capital employed, if working capital numbers are good, if the inventory days are lower, debtor days are lower. So if you're in a good situation and when we are looking at all these factors, then I think so we would, we try to narrow down the businesses. So out of the 4,500 businesses that you mentioned, right, I think the investable universe is probably probably like 400-500 kind of companies.
Correct.
There aren't more businesses that are actually
Investable.
investable, or have a good business that you would want to look at.
Right.
And then from that you want to narrow down to a list of about 100 businesses. After looking at these ratios, then you want to take a deep dive into each of these businesses. So that's the entire process of getting down from that 4,500 to
Right.
the smaller universe.
Makes sense. So we basically have characteristics and we have a scorecard system. That's how we get down to what we want to research.
Yeah.
So then the next step is when you are researching, right? What are the things that you're looking for to define it as a good business? Because we internally also discussed that for us, important thing is to find like the right business, right? The business model. So would you want to talk more about like
absolutely. I
what
can take
are
that
the attributes that we're looking for?
Yeah, so I think when we are looking for a business, what we are looking at is one of the most important skills of a manager of a business is his ability to redeploy capital and grow it at a consistent rate of return, right?
Right.
So if a business can grow at 20-25% per annum for a very long period of time, 15-20 years, I think the stock would do extremely well. So you want to look at the capital allocation skills of a fund manager. That's that's one of the most important parts. There are other factors that we would look at, like for example, if the owner is it an owner operated stock? So is the promoter fully involved in the business? How are the metrics? Is the business really scalable? Maybe I could give an example, like one of the businesses I really have liked in the past is, say, an Info Edge, the business that owns a Naukri.com. If you think of the promoter, Mr. Bikchandani, right? What he's done is that he started with Naukri.com, but he figured out ways to redeploy that capital into very similar businesses within his circle of competence, right? So he owns businesses like I think Jeevan Sathi, Policy Bazaar, Zomato.
Yeah.
So, and he's done extremely well. So, but what he's done, in this entire, in the last 20-25 years, he's figured out a way to redeploy the money that he's been generating from his original business. So, I think if a promoter can have that kind of skill, the business can do extremely well. So, that's something that we are, trying to look at when we're looking at characteristics of businesses.
Yeah.
What you're talking about is how a good business is defined, right?
Yeah.
How we look at a good business. How important it is to understand that not all businesses are good investments, right? We've seen in the past that the price also plays a very important role. So, like, how does that conversation?
No, I think Pratik, you're absolutely right. So there are times when a business could be great, but not necessarily a good investment. But I would also say there could be times where it's a good investment, but might not be a good business. I'll give an example of the latter first. So let's say, we were once looking at a company, they were in, in the space of manufacturing some films. They had a, land which was valued at close to 2,000 crores, but the market cap was close to 400 crores. Now the business is not something that made us interested in that stock, but they had that land that was lying there. At some point in time in the future, the value of that was going to be realized. So you're not getting into that business for you're not investing in the business for what the business could make out, but it's plainly because they have a land that's worth 5x, and then that is something that the market has not valued up till now. But on the other hand, there are also great businesses that might not be the best investments. You can take any household name today in India, let's say an FMCG company that selling to almost all of India. Also what happens is, since people are familiar with these names, they tend to, if they were to invest their money in the stock market, they tend to choose these names as compared to the others. So because of which the valuation goes up, and there isn't any upside for a separate fund manager to make more money in those situations. The price has already gone up, and there isn't more juice to be taken out from that. So I think both scenarios exist. As a fund manager, it's important for us to pick what we are picking up, to reason basically what we're trying to pick a company for.
So I think just to ask a follow-up, or the first style, like the first example that you gave, is it more like the cigar butt kind of investing, wherein like there is some juice left because it's undervalued for some reason, but once that event is over, you wouldn't want to hold the stock, right? Because the business is not good enough to
Absolutely
hold
right.
on. Fair enough, yeah. I think like, maybe to add, I think like the way we are looking at investing, like a good investment opportunity versus a good business, I think there are lots of great businesses available, but if it's too expensive, then it'd be too hard for us to make a lot of money on it, right? So then I guess in just that case, it doesn't become a good investment opportunity for us. But we would try to prioritize a good business over the price, and that's.
So buying quality at a reasonable price is better than buying anything cheap at any price, right?
I think it's not like a given rule, but we would prefer to buy a good quality business.
Understood.
Because if, like we said, right, like if it's a good business and can keep compounding capital, then
something that we try and avoid is also trying to catch a falling knife. We don't buy something just because it's fallen 50%. I remember that some big fund manager, a conference that Rishabh and I were a part of, fund manager said that they had run a back test which said that if you buy from the top 100 stocks, anything that's fallen 50% ends up giving a good return in the future. We don't necessarily think that's true. On the journey, something that goes from 100 to 10 does touch an 80 or a 70 in between. So we don't believe that catching a falling knife makes sense. We don't want to just buy. I mean, we need to have a rationale of why it can bounce back, and only then we can take a call of buying them.
Right. Absolutely. So I have a question in my mind. So, for example, in investing, the intuitive thought is that you would want to buy something that's at a low price, right? But if you had to ask you a question, would you be more comfortable buying something at a 52-week high versus a 52-week low? What would your answer be to that?
I think that price is secondary. What we're looking at is visibility of earnings. I mean, I can give you an example of Rakesh Jhunjhunwala. He's bought Titan at 50x the original price. He's probably bought it at $3. He bought it at 150 and at a much higher price. And to be able to do something like that, you need to have visibility of earnings, the confidence in the management, and understanding of the business. So I don't think so there's a problem in buying a business at a much higher price if the business is great.
Right.
So I think I don't think we should have biases as investors to worry about, okay, when I bought it at 50 and I can't buy it at 200 now. That's purely a factor of, your knowledge and what's going to happen in the future.
Yeah, I can in fact give you another example of a company that we bought, and then later bought it at a higher price. So this company was trading at roughly 400 rupees. The P multiple was somewhere around 27, 28. The price went up by roughly 10%. They had a good earnings, quarter, and the price jumped, but not as much as the earnings jump that they had seen. The P multiple dropped to roughly around 22. So we ended up buying more shares at close to 450, 460. That was one of the instances where we bought on the upside. But for us, it wasn't buying on the upside. The stock had become cheaper, the valuation had dropped. So for us, it was more averaging at the right time. So I think in the end, you have to look at what a 5-year view you can have on that stock, and not necessarily look at the immediate prices that they are trading at. And if you have that 5-year view, it makes sense to ride that wave.
Right. So the terminal value justifies the price today, not
Absolutely.
the past, what the stock is at.
Yes.
Totally makes sense. So we broadly have covered what to buy and when to buy, right? So something that even I want to know as a investor myself is that how much of a stock should we buy, right? That's a question that's not answered much. So what's the right answer for that question?
I can, give you one example. There's someone who I know who had a close to 10 crore portfolio. They were once invested in a particular stock, and they came to me once and said, hey, what, this stock that I've invested in last 3 months, the stock has doubled. And asked them, how much are you really holding? So they mentioned the total amount was close to 4 lakhs. And then I was just thinking that, it's possible that someone would know what to invest in. It's possible that they have the background to do the research, to do everything, but they just might not be good capital allocators. There are other situations where, let's say, there are promoters in a business and 100% of their net worth is in one company. So there are two ends of this. People, could be really overweight on something and might not really know that. And on the other hand, they could be really underweight, really be over diversified across 200 different companies, and could, still in their process say, hey, I picked a 10 bagger versus a 20 bagger, but might not have a realization how much did it really make for me. So I think understanding allocation is extremely important, and knowing when to step on the accelerator versus stepping on the brakes, really crucial.
Yeah, I think that example that he gave, right? Like a promoter can be 100% invested. And I think a promoter can be 100% invested in the business because he controls the business. He knows everything about the business. He knows, who exists. He probably hires the guys in the business.
Yeah.
And, so this comes to the point that the question that you have, position sizing is a factor of knowledge and conviction. So the confidence that you have, and I think that comes with like reading a lot more about the business, going through it, and also with time, execution, maybe attending con calls, going for AGMs, trying to understand the business in depth. So the higher the conviction, the higher the knowledge that you have on the business, it's a lot easier to increase the position size. And obviously there's going to be an upper limit from a risk management perspective, but I think that if you can read a lot about the business, if you can understand the business completely, you get a lot of clarity about the future earnings growth, and once that is there, then position sizing can be very large. But if you don't have clarity, then the position sizing is a lot smaller than what you want it to be.
So to make most of the winners, position sizing is something that has to be taken into consideration.
100%. In fact, the way Warren Buffett puts it, he says diversification is insurance against your
own mistakes.
I don't remember the exact quote, but like this is somewhere he tries to.
Yeah,
put
fair
this.
enough.
So can you think of any opportunities that you might have missed in hindsight based on just price that you thought at the time was overvalued, or some scenario that you can share with us?
I can share an example. It's not really an example that I was going to invest, but I had a view on the valuation. I'm talking about my analyst days where the Facebook IPO had just come out, and the multiples at that point that it was trading at was close to 100 times P. Now I didn't have that vision for the growth of that particular company. I think the IPO came out around $40 per share, and when after it came out, within I think 6 to 8 months it had dropped to 20, and then I built that solid conviction that whatever I had thought about the business was true, and it was going to go in that direction which I had thought. But I was extremely surprised, 10, 12 years later, the stock has almost grown 40x from that down position. And, in fact, from the IPO price, it's up roughly 20x. So there are some times that you end up missing this. It could be because of valuation. It could be because of lack of understanding or lack of vision, for that particular business. But in the process, like it's possible that you might not pick all 10 multi-baggers that come your way. But, if you end up picking, let's say, even 2 or 3 or 4 or 5, it still ends up adding a lot of returns to your portfolio.
So you mentioned this example. The next question that comes to my mind is that every investment essentially is based on some differentiated insight, right? So without that insight, to value a business, to understand a business is extremely hard. So how important or how difficult it is to understand businesses, to understand your own competence, and to be able to stick to that? Like, how is that a factor in the investing process?
So, the way we look at the business, or the way I look at the stock market as a whole, is that there's no entry barrier in the business, right? Today, I could also become an investor, and my house help could also become an investor. And all we need is a demat account and money in the bank. The only thing that differentiates me, or me from you, or me from the rest, is our thought process, right? And the way we and our knowledge building exercise, right? So if you're not reading it, so I could also buy a Reliance and you could also buy a Reliance, but we could have completely different reasons to buy it. In the short term, you will not know, who's better or who's worse. But I think over a 10, 15, 20 year period, you'll realize who's doing it with knowledge and who's doing it without. So I think it's all about independent thought process, and it's about, you gaining conviction by, reading a lot, getting knowledge. So that's the key. And the thing is that you have to play it like a marathon. You can't consider it like a 1, 2, 3 month, game. It's very long term. To add to even what Gaurav was mentioning earlier, that you're not going to get every multi-bagger, you're not going to get every 5x, you're going to get 4, 5. It's important to, note this down and to know that you're going to miss out on some of the opportunities, and to know, okay, I missed out on this opportunity. For example, like Warren Buffett, in, a lot of his meetings, he talks about how he missed out on Walmart.
Yeah.
Right? Like it was one of his, like he would call it a $10 billion mistake.
Yeah.
Right? But it's important, the fact that he says that, to make sure that he doesn't repeat that mistake.
Yeah.
He's actually learning from it. So it's a constant learning process. Even at the age of 95, you're, yet willing to learn.
Yeah.
So
I
yeah.
mean, in investing, like they say that opportunity cost is the biggest cost that does not show up on the balance sheet or the P&L.
Absolutely, absolutely, yeah.
Yeah.
Not acting, right? So even to that position sizing point, right? There's something that you're not gonna have all the answers, right? It's a game of uncertainties. There's gonna be a point where you have some amount of information and you got to take a decision, right? You'll probably have 6 on 10, 7 on 10. You're never gonna have a 10 on 10, and at that point you'll have to pull the plug. You'll have to decide that I'm gonna make the investment or not.
Right.
So waiting for that, a lot of people want to wait for the answer, and I mean, if you're gonna wait, the stock is gonna move. So you have to take that decision.
Yeah.
And so that's that little bit of luck that's always going to be involved in this process.
Fair. So my next question is that we talk about stock picking. Now there are certain different ways where people try to pick stocks based on like sectors, right? Like they have like a top-down approach where they are maybe bullish on. We've seen TV channels where everyone's asking about what's the next sector, what's the hot sector, what's the trend. So is that one of the process of finding stocks, maybe narrowing down on stocks? Is there a view on sectors that we look at it Qode, or is it purely a bottom-up good business foundations?
Sure. So, I can tell you we want to be investing in something that could look really obvious 5 years down the line. I can give you an example. Let's say we've been following the solar energy sector, and 10 years back we had close to 4 gigawatt of capacity in India. Today we have close to 100. And then the plan is over the next, 5 to 6 years, that number is going to go close to 4 to 500. Now, while I, might sit here and say today that, what the 100 was, obvious, that's something that I want to be saying 4 to 5 years back.
Yeah.
I want to be having that kind of a view on a particular business. So we want to be investing in something that could look really obvious 5 years down the line. I can give you an example. We've been tracking the solar energy sector. 10 years back, India had close to 4 gigawatt of capacity. Today, we have close to 100 gigawatt of capacity. Within the next 5 to 6 years, the target is we'll have close to 500 gigawatt of capacity. Now this might look really obvious, but 10 years back, this wasn't. So we want to be taking that call. We want to be having that foresight that, we want to invest in. Separately, I feel tech is really going to, change. Every business, you have tech that could be applicable, and if you're thinking that tech might not be applicable to your business, then maybe you won't have a business a few years down the line. I can give you an example again. Let's say if you look at the regular kirana stores versus a big basket or a Zepto, all they are doing, they're selling the same product, but it's just tech that makes the consumer experience better. It makes the item reach your place faster. The stores to get more orders. All of that is using tech. We try to apply tech in all, in everything that we're doing. We want to ensure that we are staying ahead of the curve and not staying behind. So that is another, aspect as to, where we think we need to be doing well.
So while tech has disrupted a lot of businesses, I think that it's also created a lot of opportunities. So is our investing also geared towards finding opportunities which are like a value migration type strategy? So certain times, like what you're saying, okay, certain business takes a hit, but there are other opportunities that are created. So is that also a way to find like really great opportunities?
Yeah, absolutely. It takes us back to the same example of what Mr. Bikchandani for InfoEdge, what he did, right? Naukri.com was throwing some amount of cash, but there could be a problem of scale, or there could be a problem of faster growth compared to what they were achieving when they just started out. So, and you have capital in hand. So, a good manager figures out where to deploy that capital, and that's when you look at that's when he was looking at, say, a Policy Bazaar or Zomato, and someone who knows how to allocate capital well would really be ahead of the time. So, the idea is that it all comes down to how you can allocate your capital to be ahead. Because if you're not able to allocate that capital, you're not going to be ahead of the times.
Right.
Yeah.
So let's come to the last investment decision, right? We've addressed the what to buy, when to buy, and how much to buy. Now, when we talk about when to sell, it's the last step and also the most important step to lock in the gains. So how do you arrive at that decision?
Yeah.
Right. So, what we try and do is try and understand why we had invested in the business in the first place, and then if something has changed from that which is significant and we no longer believe in the growth story, that's when we'll take a decision to sell. I can give you an example again. We had invested in this business called K-Solves India Limited. It was, an IT services business, also had their own products that they were selling. Their products were, were really top performing. In fact, at the marketplace they were selling, their products were, ranked number one on, that platform. They had close to 5% that was coming from the product revenue. Their target was, they were going to hit 15% product revenue. And the upside about product revenue is it's just recurring. There's no additional cost on that. Your branding increases, the requirement of, services increasing once you increase your product revenue. We waited for a few quarters. We ended up seeing a, close to 3x upside on that. But then the product revenue never really increased. The last quarter when we were holding it, the product revenue was down close to 3%. That's when we decided to exit. It's been quite a lot of time, and since then the stock price has stayed where it was. So I would say that if the underlying fundamentals, the underlying reason why you invested in the business, that has changed, that would be a good reason for you to exit. Another example I can give you is, in the PMS itself, we were holding a company called Suryodaya Small Finance Bank. We were really excited about the prospective growth. It was at a really attractive multiple as well. It was showing constant PAT improvement. It was showing improvement in all operational metrics. But then suddenly one quarter we saw, last 3 to 4 quarters, the NPAs that they were reporting were close to 3%. Then one quarter suddenly jumped up to 5. Now it's close to 7. So when it jumped up to 5, we thought that our underlying reason has changed, and it's no longer the business that we had put our money in. And that's when we immediately, pulled the plug and, decided to exit out of that business. So I would say one important factor is if something underlying, something fundamental changes with the business.
Yeah.
Understood. So as long as the story is intact, we keep on holding, and when it doesn't, we are willing to sell and then move on to the next
absolutely
stock,
right? Yes.
So now you've discussed a lot of the approach and the foundational principles behind investing and the decisions we take, right? Now, what I want to know, and especially like a lot of people want to know, is how have you translated that into the quant model that we have? Like, how does that work?
So I think, we get this question a lot, right? Why do you call yourselves a quant, or what is a quant essentially? I think first, to break the myth that most people think quant is I've spoken about this earlier. Quant is people think that quant is like a black box, and some computer generated algorithm will decide some stock and we're going to buy that stock. But essentially all what we've spoken about today is what we've translated in terms of a model. So all these thoughts that we've gained over years, of reading or just looking at other investors do this in a successful manner, we are sort of trying to systemize this entire process. We are trying to put it down in terms of rules, because this game is all about emotions. We're trying to reduce that that role of luck, reduce that role of emotion. So put it down on paper, put it down on the computer that, okay, fine, I want to look at these kind of businesses, I want to look at these kind of promoters, and then, do the selection of the stock. So essentially that is quant. So quant is essentially trying to systemize a very, art-driven process. We're trying to make it scientific,
Right.
to whatever extent we can.
So what my question is that is quant more of a process of rejection than a process of selection for us?
So I think what you're talking about is like a process of elimination. So that's a part of the model wherein we would say, okay, fine, we don't want to look at these kind of businesses because maybe it's out of our circle of competence, or this is something we don't understand, or historically we've seen that these kind of businesses have not done well by looking at lots of data. But that's just one of the elements. The entire thing is that quant is essentially just a tool, right? Quant is not here to tell me, it's not the investing process. It's just a tool which is helping us in making a better decision.
Right. It's not like a screener, like a random screener that people run. It's more than that.
I think it's much more than that. It's the screener is just one part of this entire thing. But there are lots of other moving parts that we would like to, put down on paper, so that we don't need to come every day and make a subjective decision, right? We don't want our daily
biases,
moods to influence our investing decisions. That's
right,
the entire idea.
Understood.
Absolutely. Yeah. And another thing that I would like to add here is today there are 4,500-5,000 companies that are listed. If we project maybe the next 5 to 10 years, that number could be 10,000, 15,000. It's going to get even harder and harder to subjectively pick companies, and if you're doing that, you could still be good at picking it, but the universe keeps increasing, so it's going to be difficult to have that attention span. The rules that we have created helps you get a good universe, that you can readily look at, that these type of businesses generally do well, and then we can be selective about how we want to be further looking at something that we want to invest in.
Yeah, absolutely.
So thanks Rishabh and thanks Gaurav. I think everyone would now be more clear as like at Qode, quant isn't just a black box. It's basically a consistent way to get like higher long-term returns. And thank you so much for a wonderful conversation. I think we got a lot of insights. So thank you.
Yeah.
Thank you, Pratik, for doing this, and it was great to have.
Yeah,
this
it's always
conversation.
good to have these kind of conversations.
Looking forward to the next one.
Yeah, perfect.